What if I told you that the financial markets aren't quite as random as they seem? Today, we're going to pull back the curtain on a really fascinating theory. It suggests there's a hidden playbook behind the big price moves, a strategy that the biggest players in the game use over and over again.
Have you ever had this happen? You enter a trade, you're totally confident in your analysis, and then bam, the price immediately reverses, stops you out, only to then rocket in the exact direction you predicted. It is beyond frustrating, and it really makes you wonder, is there something else going on here?
Well, according to this theory, there is. It's called the power of three, or P3 for short. And this isn't just about reading a few candlestick patterns. No, this is a whole framework for understanding the story behind the price. It suggests that large institutions are actually moving the markets on purpose in a very specific three-phase cycle.
Okay, so it all starts with Phase 1, accumulation. Think of this as the quiet buildup, the part where the entire plan is being set up right under our noses.
At its most basic, accumulation is just the gathering of orders. Simple enough, right? But the really crucial question here isn't what it is, but who is doing the gathering. And the players here are the big fish. We're talking banks, large financial institutions. Their goal? It's to build an absolutely massive position, either buying or selling, without tipping off the rest of the market. See, if they just placed one giant order, the price would go flying, and it ruined their own entry. So they have to do it quietly. And on a chart, this whole phase just kind of looks like a boring, sideways market, what most of us just call consolidation. And that quiet buildup leads us straight into Phase 2, manipulation. Now this is the deceptive move. This is where the trap is set.
So the whole point of this phase, and this is really key, is to create what the source material calls a false sentiment. It's an engineered move. It is designed on purpose to make retail traders believe the market is going one way when the institution's real plan is to go in the complete opposite direction.
And this slide just illustrates the trap perfectly. So imagine the big institutions have been quietly accumulating buy orders. Now, in the manipulation phase, they engineer a sharp move down. What do retail traders see? They see the price crashing and they think, oh no, I gotta sell. So they start piling in, selling their positions right into the hands of the institutions who are just happily buying everything up at a discount. It's a classic fake out.
The outcome is pretty simple and honestly, pretty brutal. The retail traders are now completely trapped. They've just sold at the exact bottom. And the institutions, well, now they're locked and loaded, ready for the real move to begin.
And that brings us to the final act, Phase 3, distribution. This is where the institutions finally show their cards and cash in on the trap they just laid. Distribution is, for all intents and purposes, the profit-taking stage. So, having bought up their position at a low price and tricked everyone else into selling, the institutions now let the price run up, and then they distribute or sell their huge position to all those traders who were manipulated and are now desperately chasing the price, trying to get back in. So, to put it all together, the very same institutions that were buying low during that quiet accumulation are now selling high to the exact traders who got caught in the fake-out. The market's true direction is finally revealed, and for them, the cycle is complete.
So when you put these three phases together, you get the full picture. You get a single recognizable pattern that we can call AMD for accumulation, manipulation, and distribution.
So let's just recap that cycle real quick. It kicks off with accumulation, that's the institutions quietly gathering their orders. That's followed by manipulation, the sharp false move designed to trap everybody else, and it all wraps up with distribution, the real sustained move where the institutions cash out with their profit.
And here's something really crucial to get from all this. This isn't some rare pattern that only shows up once in a blue moon. No, the power of three cycle can be seen across all time frames. Whether you're staring at a 4-hour chart or a daily chart, these same underlying principles, accumulation, manipulation, distribution, they're still at play.
So why does any of this even matter? Well, because it gives you a potential narrative for what's happening on the chart. It helps you move beyond just seeing a green candle or a red candle and instead start asking questions like, okay, what phase of the cycle could we be in right now? Who's in control here? It adds a whole new layer of context to your analysis.
And that kind of leaves us with a final thought here. Look, this framework isn't a crystal ball, right? But it is a really powerful lens to view the market through. Now that you know the potential playbook, accumulation, manipulation, and distribution, the real question is, where are you going to see its fingerprints next?